Good evening, everyone, and thank you for joining us today. We are delighted to host this session where we'll take you through the latest market landscape, key developments, key opportunities on the global side, and how investors can position their portfolios in the current environment. To guide today's conversation, we are pleased to invite two of our speakers, Mr. Rahul Jain, who is the Senior Vice President, Advisory and Head of Research at International Money Matters, followed by Kalpen, who is the MD and CEO at DSP Asset Managers. Before we start with giving about and handing over the session to everyone, requesting attendees if you have any issues, please write in the chat box and we will take up your questions at the end of their session. Thank you, Rahul. Thank you for joining in. We'll start with your session first. Over to you.
Thank you, Sushmita, and good evening, everyone. And Sushmita, if you can confirm if you can hear me.
Yes.
Thank you. Yeah, good evening, everyone. Kalpen is just joining. And before we start, I just want to start with a small Q&A asking how has been the last 1 year, and in that context, which asset class in your portfolio has generated the maximum return? And if you can maybe write in the chat box, will be really helpful. So if you can just put it in the chat box, which are the asset classes where you have invested and gave you maximum return in absolute term. Okay, as of now, consensus view has been gold. Okay. Equities. Okay. Barring one, as of now, I think everyone has been talking about gold and silver. And yeah. So thank you, everyone. I think, yeah, gold seems to be a consensus view that it has made highest return. You're right, but that's not the right answer. But in terms of asset classes, I will just show you how markets have generated returns overall. Gold certainly has surprised most of the investors, including us. It has delivered 63.5% return in last 1 year. And silver also has delivered 71% return. And this is very, very recent phenomena. Unfortunately, this is a lower portion of your portfolio. But good thing is at least some allocation is there in many of your portfolios. So last 1 year, equities have generated close to 10.5% return, mid cap slightly higher, small cap 3% return. But if you look at last 5 years, again, gold is something which is like 19-20% return. It is nowhere close to our financial planning numbers. These are very, very high numbers. We will cover up how do we see going forward about these asset classes. But more importantly, have we invested enough in these asset classes, and how do we want to manage these pieces of opportunities that keep coming up? So certainly the largest portion of your portfolio has not generated the return that it should have been, but still considering there are so much of uncertainties, double-digit return as of now is okay. But September, these numbers were close to 4.5%, which means it was not even beating your bank FD returns. But yes, gold and silver has been doing really, really well. And just to add, there is another component I just wanted to showcase how global markets have also panned out. In the previous slide, we have just captured Nasdaq and S&P, the bottom two, which is again in the tune of 12 to 20% kind of a return. But if you look at it, there are non-US categories also, which has in fact generated far more superior returns, which is Japanese market, again, very low exposure, overall industry-wide, market-wide. Europe, emerging market mean it is predominantly China here, which has actually generated very, very high return, which is close to 30% plus return. And again, Nifty in dollar term, because for NRIs, dollar depreciation or rupee depreciation also makes the impact. So it has actually translated to bank less than Indian FD returns for them. This is also just to give the context of currency, because you may have invested globally about in different geography, different current country, your savings could be in home country. To that extent, it is important to have a single base, which is USD. To that extent, just to read, how do we read about it? If you have invested in USD, compared to that, someone who has invested in USD versus rupee, since USD has depreciated but appreciated against rupee, so you are better off investing and holding USD and not INR. But at the same time, someone who had euro, they have actually benefited because USD against euro has depreciated, and which is what the second last slide talks about, your 5.5% of depreciation of USD against euro. Uh, with combination of all the currency combined together, we have been hearing we have been hearing dollar has been depreciating. Dollar index from 110, it has gone to 99 or 100, which is close to 10% depreciation. But few of these currencies that we have been exposed to talks about our currency, especially Indian currency, has been even weaker than USD. Uh, so just to also break down our markets return in the last 15-20 years, how it has been moving. Uh, Interestingly, these are close to 17 years of data point. If you look at it, either large caps have been doing really well or small cap. And this green colored one are the best performing in those particular year. So like in calendar year, this calendar year, the last line talks about 8.86% return, which is a best returns across these three, large cap, mid cap, small cap. So that's how it has been highlighted. So interestingly, if you notice, mid cap has never been a best performing one. And if I go back in the previous slide, which is this, if you see 5-year returns, for mid cap actually has been the best performing, wherein Nifty is closer to 14%, mid cap is closer to 26%, and small cap is 24%. In spite of not having a best performing returns, interestingly, mid caps has generated significant outperformance across large cap, mid cap, small cap. So the point we are trying to make is, now we don't know which asset class can actually give you very high return, but this is the data, which means as long as there is a consistency, there is a possibility of making long-term returns from here on, or in the past also, if you have managed risk well, there is a possibility of actually diversification playing out in the portfolio. And this is what this data says since 2008. Now coming to how we are seeing, now these are the past data we are talking about from the return standpoint. Now, what are the theses? What are we foreseeing? From where is our conviction coming in, and what are we saying going forward? Now we look at what is the valuation telling us on a broader market level. And again, the three broad category we have categorized is Indian equity in terms of large cap, mid cap, and small cap. So red line is again the mid cap. Blue line is your Nifty, which is large cap, and the topmost line is small cap. Now, in the left side, if you look at it, we have written about the historical valuation. Now, as compared to historical valuation, we are seeing large cap are still reasonably valued as compared to both the asset classes, which is your small cap and mid cap. And this gives us some kind of a comfort, saying small caps are still very expensive as compared to the historical valuation. Average is 16.7 time. We are trading at 28.3 time. That's a closer to 12-13% kind of a overvaluation which we are seeing. Large cap at the same time, 20.8 is the average. We are at 21.4, which is hardly 5% kind of a overvaluation. It is not cheap, but at least the room to correct significantly is very limited. And mid caps have also corrected to the tune of, because the earnings have also catched up. To that extent, it is not very expensive, But in these three, small cap is the one that we are really worried about because of this particular factor, which is the expensive valuation. We are also trying to break down even further within large cap, mid cap, small cap. If we go sector down breakup, how are we seeing different sector throwing up the opportunities so that one can make some kind of a market view? Are these sector combined together giving us the view about how is overall market looking? And the first one I want to pick maybe the financial sector, and the reason for that is this is 30% of our overall market. And if you see, financial is services as a sector is actually largest is considered as something which is 2 lakh crore above kind of a market cap. So your names like HDFC Bank, SBI, ICICI, Axis kind of a names will fall into this. And micro cap actually should be cheaper, but surprisingly it is expensive, which is a good scenario, good situation to be in, wherein largest sector in our economy is actually reasonably priced, makes a case for us to believe that large cap actually in this space makes sense to start participating. The second biggest sector again is maybe information technology, which is your IT. I understand growth is not there, AI challenges are there, but still there is a comfort from the valuation standpoint in absolute term and in relative term. That's another 15% of your sector, which is reasonably priced as compared to large, mid, small, and micro. Third biggest sector is again your oil and gas names like your Reliance kind of a name. Again, throwing the opportunities which is telling us large caps are actually reasonably priced. Now, this is 50 to 60% of your portfolio. Index companies we are talking about tells us large caps are actually not expensive. And as I talked about in the previous valuation chart, here also consolidated basis, it seems like it is reasonably priced. And because of these, this is our latest note that we have been talking about, and we have been circulating in our newsletter. What are we talking about to our investor? What are we suggesting at this point in time? This is the recent latest recommendation, which is if someone have to put in new money, now it has to be in the large cap space. And we are saying not to stagger like a 9 month staggering, 12 month staggering, because the valuations are comfortable. One can actually deploy in next 2 to 3 months. Mid caps are okay, not screaming buy in this case, but 6 to 8 months. And the reason for 6 to 8 months is I think we will get signals and time by getting some kind of a stability in large cap, and then followed by mid cap, and then by small cap. So we want to first load up our large cap allocation, followed by mid cap and small cap. I think in 8 to 10 months, over 12 months, you should get some kind of a earnings catch up also, which may make it reasonable. Along with, if in case we get some kind of a price correction, we will maybe come back to you guys and then say there is a possibility to do the lump sum investment for the STPs that we have suggested for. And there are gold and silver. There is also some kind of a change that we have made. You may have received our information in April, wherein we have increased our allocation from lump sum. Recently, we have changed it from lump sum to staggering over 3 to 6 months. But we have changed our stance saying, okay, we want to be neutral on this because it has gone up significantly. And we don't want to actually take a tactical overweight position in gold and silver as of now. In debt, there is hybrid, arbitrage, SIF is the new one that we are talking about. And lastly, on the duration slash debt, we are not recommending any new allocation in pure debt fund because of the tax inefficiencies. Having said that, we are also trying to reduce gradual allocation from your old debt scheme, because the case of incremental rate cut is diminishing. And there are other avenues that in industry we have gotten, which is a tax efficient hybrid product. SIF is also one of those. It is very early for us to give a comment on how this will shape up, but yes, we can talk about that as well. So these are our overall view about the market. And now from here on, we just want to shift the gear and talk about what are the other things which can help us optimize our portfolio going forward, apart from the Indian equities which are there. And on this, I I don't know if Kalpen has already joined. We want to just uh, check. Sushmita, if you can just confirm if Kalpen has also joined.
Not yet, Rahul, you can continue.
I'm here.
Okay, great, Kalpen. Yeah. So yeah, we want to then talk about there are few asset classes which we feel Indians are underinvested, either because of lack of products options available. Mainly, I think because of that. Second is because of new asset classes which has emerged because of the tax efficiencies, and one need to change about this, which is maybe a multi-asset allocation fund. It is not very old category of schemes in Indian market, and gift city slash overseas funds are again newer opportunities which are emerging. Overseas funds were there in the market. Predominantly Indian overseas funds through Indian mutual funds were available, but unfortunately, a lot of those options are getting vanished because of some limitations. And that is where we want to explore gift city options. And maybe one of the session we will just do plain vanilla discussion on SIF as well, wherein we will discuss about what are the merits and who should be looking at SIF on these species. So Kalpen, we want to start with if you can help our investor understand now markets have been actually doing really well. Is there a case for investing into international markets at all? Because India has been a growth story, demographic benefit is there, and we are also emerging market economy. Barring last 1 year, do you feel that there is a case to actually invest into global markets, and or we are better off with Indian markets?
Thanks for having me, Rahul. Good evening to everybody. I feel, statements like India is a growth story or China is a value story are incomplete truths because in investing, stories don't make money. Actually, China is the fastest growing economy on earth for the last 25 years, and the stock market has given zero returns, almost zero returns. And
Mhm.
it means two things, that the entry price then was wrong and the exit price today is wrong. And maybe it is a great entry price for the next 20 years. Who knows? So,
Mhm.
unfortunately, in investing, most of us, especially from our side, we oversimplify and we teach sometimes the wrong lessons. Actually, money is not made basis, whether you are a growth story or a value story or XYZ story. Money is made if you own great companies at good prices. And great companies can be in India, great companies outside India. There is no compulsion to earn, let's say, 12 to 14% tax-free return over a long period of time to necessarily go outside and invest. I'm saying this even though I personally have 25, 27% in global portfolios via my funds in DSP, or I'm saying this even when we are in the middle of an actual product launch, where we are raising money and telling investors to invest in that. There is no compulsion. If you are able to get your 20, 25 companies at the right price, at the right time, and be loyal to them for the next 10, 20, 30 years of your time horizon and take advantage of their long-term compounding, you can make money through any route. There are different routes to heaven in that context. So there's no compulsion to start with. Yet, why do I have 25% of my own money in global companies? Is because I believe that many times the profit pools of global companies are slightly less correlated to the sectors of India. So, like you were mentioning, and you had a very beautiful presentation that you did some time back, where you said that let's say the largest weight in India is banks and financials, and they cater to the domestic economy because they don't export anything outside. So the profit pools are completely dependent on the domestic economy, and the domestic economy will have its cycles. It will have periods of slow growth. It will have periods of accidents. Banks are the most leveraged sector, right? For every 1 rupee of equity, they need 7 or 8 rupees of debt, and they deploy that entire 9 rupees of capital. And every 7, 8 years, there's an NPA crisis. The stocks go through huge turmoil, and there are very few bankers who have become successful and emerged credible. So now to an Indian investor, like the way I think about myself is my portfolio is so largely anchored to one of the most levered sector. Having said that, it is the largest sector in our funds also. So through
Yes.
diversification, I'm able to pick up some of the best free cash flow generating companies in the consumer space in Europe or in China, or some of the innovating tech companies in China and in Netherlands and in US. And ironically, for certain unusual reasons, these companies are far more cheaper than similar or inferior business models at some points in time in India. So by buying good companies outside, by investing globally, what am I doing is I'm keep maintaining the quality of my portfolio intact. Maybe I'm even enhancing it to a certain extent and bringing down the valuation at this juncture of where India is. If we are in 2007-8, where Indian market itself is completely tanked out at 10 times, 12 times valuation, you will make mostly all the money here in India. You don't need to go elsewhere. But there are enough periods of time when Indian markets are very frothy, are expensive. A bit of global diversification allows you to balance your portfolio, make your portfolio more resilient. The combined portfolio's NAV journey is less volatile. And I believe that if my NAV journey is less volatile without compromising on long-term returns, my chances of staying invested for long improves. So all I'm doing by adding global to my portfolio is making myself a more long-term investor. And that will then enable me to earn compounding.
Thanks, Kalpen. Yes, so we are convinced that global investment is important. Maybe it opens up lot many options, and you don't have to restrict your investment to Indian companies only. And there could be lot many other sectors and other emerging trends which may be captured through that. But how does one actually take the exposure? Because it seems to be either cumbersome, or there are limited options, or you say, okay, there are minimum requirements which are there, either maybe accreditation, minimum commitments. So how does one actually take the exposure into these?
So, Rahul, as you rightly mentioned, see, the simplest way to do this, and I will tell you something which only, let's say, you and this audience should know. Do not share it with everyone in the world outside, because we have a fund where, one third of the portfolio, or roughly 25% of the portfolio, is invested in global businesses. Stocks like Berkshire Hathaway, Brookfield, Tencent, Lululemon, Nike, these type of companies. And this is a fund where 70% is in Indian companies and 30% is in global companies. And this 70% of Indian companies does not have any financials. So we designed this fund very thoughtfully with the idea that let's not own what we over own in all our mutual fund portfolios, which is BFSI. Let's make that weight zero. Let's reduce the beta of that portfolio. And let's replace that with global stocks. It's a very simple 70-30 fund. It is a very small 1,000 crore fund. It does not give very high returns when Indian markets do very well, but it defends a lot when Indian markets fall. It actually shows its color. That fund still has, let's say, around another 300-400 crores worth of limits open for us to deploy globally. But this is so simple to do that most people don't want to do, because people like something exotic. अरे 70% इंडिया है तो क्यों डालना चाहिए? मैं बोलता हूँ जो है तो वो तो लो पहले, जो
True. Okay.
पर इतना डिबेट क्यों करना है? So people ask me, RBI विंडो कब खोलेगा? I tell them RBI doesn't report to me. I can't do it. And RBI has, reasonable, logical reasons to do what they are doing. You have easy options available. You want to jump small barriers, or you want to only jump tall barriers. So that's the first option available. The second option available, again through a very simple, tax efficient, cost efficient, credible mutual fund route, is the category called multi-asset funds. In multi-asset, we launched this fund 2.5 years back. We are very happy. It's delivered 18, 19%, 20% CAGR returns, while markets have delivered only 16. Because the global component did very well. That has 20-25% in global stocks. So these are two first easy options for anyone who wants to start. Now, if you say that, no, I don't want anything which has Indian stocks, or I don't want anything which has gold, silver, bonds, apart from global stocks, give me 100% global option. Either you go to Interactive Brokers and set up your broking account and start buying stocks on your own. All the best. If you know how to do it, great. But most people who don't even know the taxation of mutual funds today ask me, I want to buy this stock in Brazil. Is it a good company or not a good company? So, people have illusions of how much they know. Just having access to companies is not good enough. So that is another option, but it's not easy, because out of 10,000 stocks in the world, how will you decide which 10 are relevant for you? How will you decide? So today, a lot of people want to buy semiconductor and AI stocks without knowing how to analyze AIs. AI businesses without knowing what are the right valuation frameworks. So direct investing is available, but it comes with a lot of risk. Then the next option that is available is under the LRS window again on GIFT City. There are few funds which some of the fund managers, including us, have launched. We have launched a retail fund because our whole idea was we don't want to launch a high ticket size fund which eliminates 95% of Indian investors. Because the moment I keep a 1 crore threshold, 1.5 crore threshold under the AIF version, 95% of investors will get, in fact, 99% investors will get eliminated. So we took the tough path of a retail fund, and that has a $5,000 ticket size. It's a retail fund on the GIFT City platform. It's called Global Equity Fund. We have collected only around 70 crores so far. It's a soft launch. There's a lot of education that needs to be done in terms of operational processes, how to transfer money to GIFT City accounts, so on and so forth. But to my mind, today, if you want a 100% global portfolio for moderate ticket sizes, that is the only option as of now available for investors. So I think you've shown the various options available, and the outbound investment through the retail version is a very sensible way to start investing.
Yeah, so you're saying this will be a tactical call as of now, or it has to be a strategical call? Because in our mind, we are saying through GIFT City or through international platform, we are thinking this as a core allocation, strategic allocation, because in India, we are also a little uncertain about, we have been hearing you start recommending a fund and after 1 month, 15 days, 2 months, 3 months, either fund stop taking money or funds stop taking exposure to the international equities.
Sure.
And to that extent, if you want to keep maintaining certain asset allocation in the fund, so product like your GIFT City fund or someone having international platform can have a static percentage allocation of their overall portfolio. Does that make sense?
So, Rahul, I think your dilemma is valid, but the way I think about it is that, we can make lemonade only from the lemon served to us. So let's assume you start investing something in a mutual fund which has some exposure to international stocks.
Right.
3 months later, they stop. Maybe 1 year later, the exposure gets toned down. But whatever you get in, at least is a good start in the
Makes
simplest
sense.
possible way. By pressing two buttons, just two buttons, you can start that today. Because those processes are streamlined. You don't have to worry. And there are a lot of advantages, Rahul. And at the cost of partly reselling my global fund, I'm saying this to you in all honesty, that when you buy it through a mutual fund route, even the currency conversion rates are the cheapest. You
I
will get
understand.
conversion at the rate DSP gets it, at an instant,
Correct.
1 paisa, half a paisa. If you try to do it on your own, in fact, if you don't have leverage on your banker, you have to pay 1.5% on both the legs. So all the delta that global companies are going to give you will actually get eroded, and you'll eventually make the same return as Nifty perhaps. So just keep that in mind. Number one. Number two, any investing generally should be long term. This is not tactical. And when we say global, our way of building the portfolio is no different than how we build an Indian portfolio for the next 20 years. In fact, we take a lot of pains to explain to investors that it doesn't matter whether my portfolio has a US tilt or a Japan tilt or a China tilt. That is not the point. When we say global, it is global. And the more important principle is we are buying good companies, the best companies of the world at reasonable valuations. This is the framework that is the hero framework. The framework is not India or global. The framework is not China, US, or which sector. The framework is the best business models of the world, where building such a business would mean a lot of hard work. It would take decades of work to build businesses like this. And such businesses, when they are going through their temporary phase of either a disbelief by the market because of certain events, and hence their valuations are cheaper than the intrinsic value, and cheaper by that much amount that if we want to earn 12 to 14% return conservatively, if you give us money for 5 years in dollar terms, we should be able to do that. And that is a function of the price point. So typically the portfolios will have free cash flow generation sustainably happening, and valuations will be reasonably moderate. So that's the ideology. So today, this principle is leading us to invest in 5 stocks in China. This framework is taking us not to the magnificent 7 of US right now. Only two from the Magnificent Seven are coming, but we are getting many other businesses in Canada, in Japan, in Europe. So in France, for example, we are getting a company which is one-fourth the valuation of its comparable company in India today. So the ideology that I want your investors to keep in mind is the ideology of businesses which are solid, which continue to generate free cash flows over the next 10, 20 years, and you are able to buy them at reasonable discount. Then it doesn't matter which country. And lastly, let me give an example. Let's say Louis Vuitton. Louis Vuitton will be shown as a French company. So in my portfolio, it will look as if we have exposure to France. But dominant revenues of Louis Vuitton don't come from France. France is a tiny country. Most of its money comes from the bags they sell in China, in rich Asia, and in America. So is it a French company? Obviously, I will say it's a French company, but technically it's a global company.
True. I agree. I think your point of currency conversion is valid, and we have come across. We are
So I would
doing
say,
our international remittance,
yeah,
and if they have not negotiated, they have actually got very, very, I would say, raw deal about conversion, which is like 90 plus 90 and a half, 91.
yeah.
Without any negotiation, that's the rate, which is actually very, very expensive for them to remit that.
Yeah.
And also, sometimes lack of understanding about newer product option. So I was reading there is a product which has come up recently globally, which is X Magnificent 7, X Mag. Now, if you
Sure.
want to take exposure in US and you're saying I'm worried about actually those seven, now can someone research and find it out and buy those? So your exposure of US is taken care of and your risk is also mitigated. But how quickly or who will be taking that call, which is where fund structure I think will makes a lot of sense for a long-term higher allocation if in the portfolio we are talking about.
So Rahul, let me just clarify that, everyone says the magnificent seven are in a bubble and so on and so forth. The real bubble was in 2000 when the top 10 stocks were at 90 P, 100 P. Today,
Right.
these stocks are on an average, the whole universe will be at 25, 28 P, which is same as where the whole of India is. So if you're worried about the magnificent seven's valuation, you should worry about the 99% that we have in India today. Because our entire market valuation, we don't, so all the experts who say that Max 7 are expensive are also there on television saying India is cheap at 25 times. So really these things have to be analyzed, and that's where the role of experts like you becomes very important.
Yeah. So thanks for this piece of inbound product and outbound product. Outbound is for Indian investor, basically investment outside of India. And Indian investor can put in money through LRS, and global investor can put in money without LRS, but still can take the exposure in global market. In inbound, because this is underlying India, Indians cannot put in money. It will be considered as round tripping. So hence, only non-Indians, NRI can deploy money through that, wherein they can take India exposure. But the platform is like a gift city, which is equivalent to your Mauritius, Cayman, or DIFC equivalent structure. And then the last option, you have the platform. You may be having any online platform, but one has to be careful about the currency conversion. Next point, so one is this, which is international allocation. Another piece we are thinking, Kalpen, and just want to brainstorm your thoughts on this is clients. We have been working as an asset allocator, saying equity and debt. We have pure debt allocation, we had equity allocation, we had gold allocation. And going as of now, we are speaking. There are hybrid funds which has been catching up the momentum, not from the return standpoint, but from the allocation standpoint. Now, how important are hybrid according to you, and more so, which is a multi-asset allocation fund, because this is new breed of fund which is very, very prominent in last 1 or 2 years. It was not there 5 years back. BAF clients have got, which is balance advantage fund. I can share. I was looking at data. The experience have been very, very good industry wide. Forget about our client. Industry wide, the experience has been good. This multi-asset allocation, how does one position it? What should be our expectation? Why is it catching up so much momentum?
So let me start with my own behavior. My monthly salary after whatever expenses all goes to multi-asset right now because
100%.
100%.
Wow.
as of
Okay.
today. So, in this regime, and I started this around 2 years back when we designed, see, we normally at DSP launch funds where we believe we will put our money. If
Sure.
we can't put our money, and we'll not tell you and your investors to put money. Now, why multi-asset, at least in this regime, since last 2 years, it was 2 years back when we analyzed the risk in the market. What we felt is global stocks over a decade had given very inferior returns, and some of the best businesses were becoming extremely attractive. Some of the
Right.
companies like a Nike or a Novo Nordisk, or Tencent or an Alibaba or Kai Chow Motai, all of these are like dominant businesses, great market share. They had halved in their prices because in the prior 5-7 years, their valuations had run up. They had become too popular based on certain narratives and story, and then they had started correcting. So when great businesses become cheap, so that was an opportunity. On the other hand, gold and silver in dollar terms, almost for a decade, had given very inferior returns. Silver virtually negative. Gold returns were like single digit, much lower than single digit for almost a decade and a half. And we all have been aware that the whole world is in a way fragile with a lot of leverage sitting on balance sheets of different countries and central banks. People have just printed more money. So the size of financial assets in the world has exploded in the last 15 years after the 2008 crisis. So, and financial assets can be created in a way in thin air. You can issue more currency, you can issue more bonds, you can come and raise more money through IPOs. But hard assets like oil or precious metals cannot be created in thin air. So
Right.
size of that space had remained constant over the last 15 years, and financial assets had multiplied manifold. So relatively, we felt that gold and silver should have been, were more attractive. Indian government bonds, when interest rates were closer to 7.5, 7.75 2 years back, were also reasonably attractive because if you're earning in a slowing economy 7.5%, inflation is 4, you're getting a rich 3.5% real spread. And on the other hand, Indian stocks, where we are fully over invested in, were sitting at very high rates of return. Long term median returns of Indian equities around 14%, but years back, the last 5-year return had gone up to 20%. So we felt that this was a time to introduce the three other equally good asset classes in medium to long term, but going through a phase of underperformance. And that's why we built multi-asset. And the category also has done well in the last 4 years or last 2 years. Now, I am in dilemma at this point that incrementally now should I continue with, so I still feel hybrid should be the way to invest at least in the next 3 to 5 years till
Okay.
valuations normalize. Unless you are an investor who does not get perturbed by any intermittent volatility. See, the choice of funds or category is a function of our behavior to volatility. My
Right.
son, who is studying engineering, I'm investing 5,000 rupees for him in an equity fund today. Any volatility, he doesn't care because he doesn't know it much. And
Sure.
he's not going to be affected. And his money is, let's say, for the next 20-30 years. So his portfolio has no hybrid in it. It doesn't have multi-asset. It doesn't have balanced advantage fund. My portfolio, because I daily embrace volatility, I daily encounter volatility. I have my own pressures of volatility. I have to answer investors' questions on volatility. So my portfolio, I have tried to cushion it with some impact, some hybrid funds, so that volatility can be neutralized. So it's a personal choice. So likewise, if today 40 people are listening this conversation, each one will have a personal choice, which you and your teams will guide. So that's the starting point. So it's wrong to say equity funds are good for you or hybrid funds are good or everything is contextual. Now, I still feel, and let me give you the mathematical reason of why multi-asset fund should be the core of any investor's portfolio, however long your time horizon is. Long-term median return, like I said, for Indian equities over the last 30 years is around 12 to 13%, 13%. And median return means the return that most investors have earned, not the 18% which only few have earned, or not the 8% which again many have earned who invest in bull markets and in bubbles. So the likely return is around 12-13%. When you mix these four asset classes, the median likely return over long periods may not be 13, may drop to 11.5, slightly lower.
Right.
Volatility cuts by half. The fluctuations cut by half. Now, one way of cutting fluctuation by half is to reduce your returns by half. But here, the return is coming down by just around 1 or 1.5%, but the fluctuations cut by half. So if you are
Yeah.
for a 5-year plus horizon, multi-asset funds even today make sense. Now the disclaimer. Now, what is my anxiety for multi-asset funds? Almost 30% of the portfolio of all multi-asset funds is in global stocks or gold and silver, between 30 to 40. Now, gold and silver are at unusually lifetime high levels, and recent times, global stocks have run up very sharply. So they may or they can encounter more volatility than a pure India focused equity and debt fund. So the only disclaimer I'm saying is that in the next 1 or 2 years, multi-asset funds may not do as well compared to a simple hybrid fund. I'm using the word may not. May not means it may also. Some things is about probability. I'm not able to assign probability that in the next year or two, multi-asset will do better or worse. 2 years back, I had reasonably high confidence. Today, it is in the middle, because the India equity component for last 1 year has given almost zero return. And whereas gold and silver have risen very sharply, they can even correct sharply. It's very difficult to take near-term views on this. So if you're a shorter-term investor and where volatility can affect you, then avoid multi-asset. But if you remain a 5-year, 10-year investor, it's a beautiful product, and I'll tell you why. It allows you 4 asset classes. It allows rebalancing without paying a single rupee of tax, and it reduces volatility to enable you to be a very long-term investor.
Thanks, Kalpen, on this. So we have captured this from your presentation. I don't know if it is the latest or if there are any changes, but this was
Broadly, the structure is the same. There's no change, but I'll just fill up the numbers. Currently, the Indian equity component is around 44%. It was 38% some time back, but in the last few months, we have increased the weight because Indian stocks had corrected a bit. The international exposure over the last 2 years has been around 24%. We have currently just booked some profits and brought it back to 17. We may increase it again, as the same stocks either consolidate or we get new stocks to invest. But roughly 20 will be international at most points in time. Gold and silver was 22 at its peak till just few weeks back. Today we brought it down to 30. We have almost brought down the exposure because they've run up too sharply. And bonds are the balance 25%. We have a small 4% exposure to REITs. It's not very large. In my view, there's a lot of hype around, if you have REITs and InvITs, it's a great fund because you have added a new asset class. But we are going to release a small white paper very soon, which will show that REITs, global experience is REITs are as good as equity from a volatility point of view and from a long-term return point of view. So in a way, they do not create significantly lower correlation. So broadly, that's the design right now.
Makes sense. So the reason we have been bullish about multi-asset allocation is precisely these 2, 3 reasons, which is fund manager have the ability to move within these 4 asset classes. Because like a balanced advantage fund or a balanced fund, there are sometimes 2 asset classes or at best 3 asset classes. But here you have Indian equity, international equities, debt, gold, and silver, REITs, InvITs. So all these are, I think, are the only asset classes which are available. And this fund have the ability to participate in all of this. At the same time, as Kalpen mentioned, there is no tax incident by booking and making these changes. And you may want to actually make those changes. Sometime emotional decision kicks over and you may not be able to take the call. Like gold and silver, we may be thinking of strategical call and fund manager is thinking of a tactical call, wherein your 22% gold allocation, Kalpen just mentioned, is come down to 13% now. Our investor, we may not have book profit because it may be a long-term strategical allocation. So that I think is very, very critical. And any thoughts on the global multi-asset allocation as a strategy, Kalpen, if you have studied about how this has worked in the global market also, because this is new in India, but must be very old in the global context.
Yeah, so very good question. And it's good that you asked this question, Rahul, because if the concept of multi-asset allocation works in India, if it is a good concept, logically it should work everywhere else. And if over 30, 40 years, if it has not worked in other markets, we can't unilaterally say that it's a concept, because a concept has to be largely universal. Now, we have one slide in our multi-asset presentation, and before launching the fund, we had done this study that does it work everywhere else. It showed that in almost all markets, developed markets, developing markets, poor markets where governance, etc., is very bad, like Pakistan, Turkey, these type of. We looked at those markets also. Everywhere multi-asset works. because what happens is that whenever you are investing outside your home country,
Mhm.
global stocks and gold are a hedge against your own currency. Now, the last few decades has been the dominance of US and the US dollar. So almost all emerging market countries, their currencies have weakened. So whatever return they earn on their bonds and on their stock market, that becomes much lower because of the currency depreciation. And on the
True.
other hand, if they've invested in global stocks, typically denominated in stronger currencies or in gold, which again is in a way a dollar return product, what happens is it adds slightly higher returns to your domestic portfolio. So in 100% of the markets, the returns from multi-asset strategy were closer to the domestic stock market with 40% lower volatility over a long period of time. This line has to be underlined over a long period of time, because tactically in between there can be a year or two. Like if last year, I think Turkey market gave the best returns in equity.
True. Yeah.
The multi-asset strategy in that 1 year, they would have underperformed. Or I think 1 year prior, Pakistan gave the best return in equity. So their equity market for that 1 year would outbeat any other country in the world. But over a 10-year period, when the equity market collapses again, over
Yeah.
a 20-year period, multi-asset has, I again repeat, that in India, if you are a 25-year investor and you are not worried about volatility, don't do multi-asset, only do Indian equity funds, because at least history has shown that a 100% equity portfolio has done better, provided you stay invested for those 25 years. But if volatility unnerves you, then choose multi-asset.
Got it. Yeah. This is helpful. Any other asset classes, any other thoughts? Since the topic is for next 5 10 years, one have to start building a portfolio. And considering you're seeing, you know this market pulse, how overall portfolio construct is there in the market? Predominantly Indian equity. I don't know the positioning of overweight on small cap, because still last year we were seeing flows in small cap were even larger than large cap. I think that has been toned down, and someone who has been putting large cap in last year has actually not made money. So, what, according to you, should be the right thing to construct right now? Because in tough time is where you may want to capitalize on those opportunities, maybe from the regulatory standpoint or opportunity standpoint or from the combination standpoint, apart from these two, three things that we talked about today. Anything else apart from these?
So, Rahul, today, practically, the way to always think is, where is risk badly priced and where are
Mhm.
opportunities? Actually, every part of the market is slightly ahead of what fair value should be, whether it is
Right.
small cap, whether it is mid cap, whether it is small caps. And in some, segments like mid and small cap, the overvaluation is a bit higher than what it has been in the past. So I do feel that, and which is why I made that comment, that in this phase, hybrid funds are better, because this is a phase of wearing your seat belts or wearing your helmets before you go to play. This is not a phase where you remove your helmet and say that we full toss mil raha hai, so let me go and hit a six. In
Yeah.
bear markets, we should be aggressive like that. In super bull markets like right now, we have to be a bit defensive, a bit conservative. And today, most pockets of the market are ahead of fair value. Uh, Relatively, the data that you showed, that financials are closer to fair value. They are also expensive, but they're
Correct.
closer to fair value. Relatively, the largest market cap stocks, the largest 10 stocks, you showed one of the slides that we had also recently published, have they are closer to fair value. As you go away from the largest market cap, as you go away from large cap, the distance from fair value increases. So, we have an interesting index fund or ETF called Nifty Top 10 Equal Weight Fund. Now, let me just explain to you why I mean they are closer to fair value is, 7 out of these 10 stocks have underperformed everything else in the market in the last 1, 3, 5 years. So
Right.
they are dominant companies, but they are in a low cycle. So whether it's Reliance, Infosys, TCS are down 25-30% in this year.
True.
ITC has gone nowhere in the last 2 years. And then Axis Bank, HDFC Bank, Kotak Bank, last 5 year, 7 year returns are, below 50. The only 3 stocks which have done very well in these 10 stocks, one is, I think, Bharti, one is ICICI Bank, I'm not able to think which is
Maybe HUL or something. HUL?
HUL is not in the portfolio. HUL is
Okay.
so Bharti replaces HUL. So 7 or 8 out of 10 have actually underperformed. And generally, when you invest in underperformance of good companies, is when you get out
Yeah.
in the next cycle.
This, yeah, I think this is really helpful. The whole idea was if we can find out those 2, 3 pockets of opportunities wherein large chunk of money can be absorbed, because if we identify stock, it cannot absorb large chunk of money. If you identify a very, very volatile asset, it cannot absorb large chunk of money. And how will you consolidate the portfolio? Because opportunities like this, as I did not know, you are saying 100% of your new money is at least going into this asset class. Now, we don't want to go that route, but still, can it absorb at least 10% of the portfolio? Is it comfortable? The answer is yes, it should be comfortable, because your gift city is again a fund structure, managed different geography, different asset class, different sectors. And same is the case with, I think, multi-asset is even more diversified. And that is the reason we thought these are the two categories which are
I,
very, very underplayed right now in at least our portfolio for sure. I don't know about the industry.
so Rahul, 2 comments on this. That I think multi-asset should be a very large. Let me tell you my overall entire portfolio over last 28 years that I've been working, and whatever small personal corpus I have built.
Mhm.
90, 95% of it is in mutual funds.
Mhm. Okay.
The balance 5% is 4% in sovereign gold bonds, and
Mhm.
1% is in stocks that I had, very badly bought in the 2007-8 bull market. And
Okay.
they have, corrected by 70-80% to become just 1%. So after 2008, I stopped investing in any Indian stocks because also over time it is our skin in the game that if we tell you that mutual funds are good, then we should not be not investing. So everything is mutual fund. Now, this uh, assuming if this 95 rupees was 100 rupees, what is my breakup today? My breakup today is 40 rupees in through these mutual funds, 40 rupees in Indian stocks, roughly
Mhm.
75 rupees is in global stocks, roughly around 15 rupees is in gold or gold related funds and gold bonds. So 40, 25, 65, 65 and 15, 80, and the balance 20 rupees is in bonds.
That's right.
My entire portfolio is actually a multi-asset portfolio. If you ask me, it's 100%.
Understood. Yeah.
But it is not through just the multi-asset fund. It is through
Correct.
also other. So I have this value fund where 30% is in global stocks. So that also contributes to my global portfolio. I
Understood.
have a dedicated short-term plan which contributes to the 20% of the debt component. So whichever way, the entire portfolio is multi-asset. And it will become probably closer to equity when we are in a low cycle of equity. It will remain closer to multi-asset when we are in a high cycle in equity. So that's how I typically tend to navigate. Now, today, because these portfolios have range of diversification available, they can absorb much higher degrees of.
Yeah.
And remember, today the challenge of investing in small and mid caps is more pronounced in India because free floats are less. Good companies that
That
you
is
typically a promoter will own more of that, and it
true.
will be less free float. And when free floats are less in a bull market, the valuations are too high. So
Yeah.
even if you buy the best company today, the stock may not be the best from a return
Yeah.
perspective. But globally, what has happened because of real-time volatility, if stocks announce bad results, stocks are down 20% within no time, it allows you to, those categories are able to absorb more money. So I think
Yeah.
those are the nuances that make me more comfortable adding global component because we are already loaded with Indian stocks.
Absolutely.
That is
Yeah.
why incrementally some of these ideas. But last point I would say is that remember gold, silver, and global have run up more sharply in the last 1 year. So expect volatility there in the next year or two, and hence
Yeah.
gradually invest your money. Don't go all in. Just and I know, thankfully, I've known you for more than a decade. You are one of the most disciplined, investment advisor. You are one of the earliest RIAs of India who have always kept investor interest first, and you operate with full discipline. So I'm sure your investors are in very good hands.
Thank you so much. Thank you. Thank you, Kalpen. If we can open up for Q&A, if participants have any questions, Sushmita, if you can open up for that.
Yeah, thank you, Kalpen. Thank you, Rahul, for your useful insights. We will do short feedback about the session while people are posting their questions in the chat box. In case you want to speak, please raise your hand. I can unmute you.
So, Kalpen, just to ask before anyone else maybe having a question about existing debt funds which are part of the client's portfolio, how are you seeing movements happening for that? Is that money shifting to different types of hybrid funds? Is it getting into equities? Is it getting into large cap, global? What are you seeing? Because industry-wide flows in this category on net basis is actually coming down.
So what has happened, Rahul, after the tax changes which happened 3 years back, suddenly when debt funds started getting taxed at marginal tax rates, particularly the high net worth individuals, they stopped directly investing in debt because it became reasonably unattractive. The returns after tax, if broadly bond yields are at 8%, for example,
Yeah.
take out fees, let's say you are at 7% return and then you pay 30 to 40% tax, what is left in your hand is 4.5. And the last 2 3 years were such where on a monthly basis, sometimes the stock market was giving 4% return. So, actually, hybrid funds became an alternative to debt fund, though technically not correct, because hybrid funds do have meaningful equity to give you negative
Yeah.
return. So technically, debt funds can't be seen as an alternative to hybrid funds can't be seen as a pure alternative to debt funds. Now, in the last, so far, arbitrage funds have replaced debt funds, so they are a good proxy for debt funds.
Yeah.
And hybrid funds have replaced debt funds, which are not a great proxy. But if you split, let's say earlier I used to do 70 rupees in equity and 30 in debt. But now because debt has become tax efficient, now instead of doing 70/30 in two separate categories, I do 70 rupees. I do my entire 100 rupees in my aggressive hybrid fund, which is also
Makes sense.
30. Then it is a better way to invest
Correct.
the debt component. But in the last 6 months, the fund industry has created a very efficient fund of fund, which is called income arbitrage fund of fund category. So here, 65% of the portfolio goes to a debt fund and 35% goes to arbitrage. So if your holding period is 2 years and above, the entire return becomes tax efficient and is taxed at long-term capital gain rate of 12.5%. So you still earn returns of a debt fund, let's say in this cycle,
Yeah.
will earn 7.5%. Net it off by 12.5% tax, you still earn around 6% post-tax versus pure debt funds with no tax advantage earn 4%. So
Yeah.
category many investors are not aware of. Only
Yeah.
institutional investors have been investing in that. But if any of your investors are interested, that they should evaluate and study that.
Got it. Yeah, thank you so much, Kalpen. There is a question now in the chat box. Based on what I have heard, should one therefore move fund out of gold and silver and not invest anymore?
So, Neela, that is a question which is my dilemma also. Like I said, 15% of my portfolio is in gold or gold mining. One of our fund, we have a very volatile fund. We normally don't encourage for retail investors called gold mining. So from 14%, reluctantly, I brought it down to, from 15, I brought it down to 14. A very nominal 1% shift I have done. Normally, I don't like to take money out because every time you shift money, you have to pay huge amount of tax and you lose long-term compounding of the money paid out in tax. So I ideally, and secondly, you have to see that, if your gold and silver exposure is within 10% of your portfolio, I would still say let it be because, over a 30-year history, in most emerging markets, gold has earned same return as their stock market. In India, thankfully, we are blessed to have a more meritocratic stock market. We have a lot of entrepreneurs and companies which are creating wealth, which are operating businesses with very high credibility and capital efficiency. So equity markets have generally done better than gold in India. But in all other emerging markets, gold's return has been same or higher than equity market. Now, can the last 25-year experience be different than the next 25 years? Yes, anything can happen. And we are also sitting at a point in time where, like I said, global paper asset classes have exploded, whereas real assets have remained stagnant from a total quantum perspective. So less than 10% don't do anything. More than 10%, maybe you should rebalance. More than me, your doctor is Rahul, so you should ask that question to Rahul.
I think clients' advisors are their best doctor. But yes, we are also talking about be stagger and not be overweight at least from here on. Another question is there are quantitative easing that has been planned in economies like China, Japanese market, and US is also planning $2,000 one-time check to all residents. how do we see the impact of this on the global equity market? Any thoughts on global quantitative easing?
What US will do will affect little bit of US, and what US will not do, no one knows. Every second day they announce something. So these are very difficult variables to really understand. And QE, sometimes the world goes through quantitative easing, sometimes it goes through QT. These are macro variables which are moving very fast, very difficult to analyze, and which is why we try to find simpler anchors where we need to analyze less factors. Because if your dashboard has 100 data points which are constantly moving, it becomes very fuzzy because they are always moving in opposite directions. They don't give a pattern. So we avoid decision making which needs 100 variables. We prefer decision making where even 5 variables are good enough. You don't need the sixth variable, or the sixth variable is not adding any incremental value. And in that context, when we say that the two variables we are narrowing down to are great businesses who have a free cash flow yield of 4-5% in dollar terms, plus another 5-6% profit growth rate at least. So when you add these two, 10 to 11% growth in terms of dollar terms is actually more or less safeguarded. And on top of it, if some bit of valuation re-rating happens, you could earn slightly more. So we are not trying to be very ambitious to earn 20-25% return. We are saying in a era where interest rates are or inflation is 4-5% in India, if we can earn another 6-7% and earn a total dollar return of 10-12%, if we earn more, it will all be bonus. We'll not say no to extra returns if we get them. But our design thought is very conservative. We want to choose conservative businesses at conservative valuations. And like I said, today the portfolio has companies like PDD from China, Anta Sports, Nintendo, BYD, Tencent, Alibaba. Almost all of them are at much reasonable valuations than some of the dominant companies in India today. Or China is just one slice. China is only less than 18%. But we have companies from France, for example, from Europe, we have companies from Japan, we have Airbnb, we have Lululemon. Stock is down 60%. It's a brand most people would be aware of who are into fitness. We have recently added Puma. We have recently added Deckers in the portfolio. Deckers is the maker of Hoka brand of shoes. Very, very fast growing brand.
Correct.
Now that stock is down 60% in the last 18 months because the market was worried about tariff and trade wars and impact of slowdown in China. So a lot of these macro. So what we do is we look for good companies, and when all the macro news punishes that company or creates uncertainty about these businesses, but the stock becomes so cheap that even if bad news were to play out, it will not further impact the stock price. So we look for companies where the expectations priced in are too low, that most often they will end up meeting those expectations. And hence, I would not worry too much about a lot of these factors. After all of this, any portfolio can fluctuate by 20-30% at all points in time. In his last letter, Warren Buffett said that, we will manage money in the best possible way as we have done. We will give you the best in class investment expertise. In spite of all of that, the Berkshire Hathaway stock fell by 50% thrice in its history and will fall again by 50% thrice in the future also. You can't avoid these short-term periods of volatility. And the best to overcome that is asset allocation and SIPs.
Sure. Thanks, Kalpen, on this. There is another interesting question on the risk, and I really like that question, which is, are there any liquidity risk across the non-equity sleeves, particularly commodities or international exposure in multi-asset portfolio that could impact the fund during stress period?
Thankfully, after the liquidity crisis, which we saw post-COVID, the fund industry, regulators, SEBI, RBI, they've created, far more stronger risk management guardrails. They have said that, any debt fund should have minimum 10% in highly liquid government bonds and treasury bills, so that, even in a bad liquidity event, that 10% is available to investors. There are limits on how much you can invest in a specific sector. There are limits in how much you can invest in NBFCs, which are sometimes illiquid. So at large, there's a lot of progress that has been made in various debt mutual funds to enhance the liquidity. Having said that, anything beyond government bonds, the overall traded volumes are generally very low. But we don't worry because last 5 साल में debt fund में इतना पैसा ही नहीं आया है.
नहीं आया, right.
आया नहीं है तो जाने के लिए time लगेगा.
Sure.
Liquidity.
Right. Yes, I think there are no more questions. Sushmita, if there is any other question, please let us know.
No, I
I
think there are
think
no
I
more
can see.
questions. Thank you for a very insightful session, Kalpen and Rahul. I think all the questions and the confusions that a lot of our investors had in terms of positioning both the global and the multi-asset, I think has been catered very well and articulated also well. We'll continue to do similar sessions in the future and requesting everyone to please share a small feedback about how did you like the session. In case you would like us to do something else, please share the same with us.
Thank you so much.
Thank you,
Thank you so
Kalpen.
much,
Thank you,
Kalpen.
Rahul,
Thank you,
for being
everyone.
there. Thank you.
Thank you, everyone, for joining.